So this is Professor Zan, and today we're going to talk about Chapter 8. Chapter 8 is about accounts receivable, bad debt expense, and interest revenue. So when we offer customer a credit, meaning we give customer a few days for them to pay us back. So the advantage of doing that, it helps us to increase our sales because the customer don't have to pay cash up front, so that kind of like stimulate the sales, right? That's advantage. Disadvantage of that, as you a company who offer the credit terms, it increase a lot of cost. Number one, you have to hire a employee, or you need to give employee additional work by collecting those cash later, and also you have to spend a lot more time monitoring tracking those accounts receivable. So there also is a possibility of these customers not paying you later, or not you not be able to collecting the full amount, or the customer may even go bankrupt. So the third is you delay the receipt of the cash because you're not receiving upfront. You delayed for 30 days, 60 days, or even 90 days. So by delaying collecting of your cash, you incur additional financing cost, right? So now let's talk about the estimation and report of the uncollectible account. So when you first initially, when you made a sale, you made a sale, right? At the time after you made a sale, it's time for you to recognize your revenue because you finish your earning process. So you debit your accounts receivable. You didn't receive your cash, but you have the right to receive the cash from your customer. So your asset in your balance sheet increased. At the same time, your equity from your revenue, because you increase your revenue, so your equity should also increase. That's in your income statement. You have sales revenue, right? So, and then, before you know the bad debt, the exact amount of bad debt, exact amount of not collectible. So what you need to do in the middle, right? So you have sales revenue comes to in the middle, say the month's end, in the end of January. You made the sale in January 1st, but the end of January 31st, that's when you end of accounting period, the first month's period. So at that accounting period, remember we talked about the matching principle. Matching principles says that you have to align all of your expense in the months where you made those sales, right? That's called matching. So by the end of January, we kind of have to estimate it how much of these receivables you cannot receive. So that's what we call bad debt expense. These bad debt expense is a reduction of your sales revenue as part of your operating expense. So, but at that point of time, because it's still estimated, so we created another account called allowance for doubtful account. This allowance for doubtful account is a contra asset account to your accounts receivable. So it's a deduction to your asset. It's not direct deduction for accounts receivable yet, but it is reduced to your accounts receivable. So you have this net accounts receivable. So this allowance account is impacting to your balance sheet, and then bad debt expense is impacting to your income statements. So that's the transaction. You debit bad debt expense and credit allowance for doubtful account at January 31st based on your estimation. So, and then later day, you know for sure that's how much you're gonna not be able to collecting from your customer. So your bad debt became known. So at that point in time, you have to reduce your allowance for doubtful account and then create a direct deduction to your accounts receivable because you know for sure this amount of money you're not going to receive it. But you don't need another recognition of expense because you already record your expense at the time when you made the estimation. So you don't need another bad debt expense. That's why there's no impact to your income statements. So allowance method allows you two-step process. The first one, you made an end of period adjustment to record the estimated bad debt in the period credit sale occurs. That's for the matching principle, right? You have to make the estimation first. So the second step, when you know, when this uncollectible become known, so you have to remove this customer balance, right? This is what we call write-off, and that write-off is just a reduction of your balance sheet. The first step is the income statement impact. Also creates a contra asset account called allowance for doubtful account in your balance sheet. The second one just reduce directly out of your adjustment of your accounts pay receivable. So let's see. This is example. It's saying VFC estimated $900 in bad debts at end of the accounting period. This is the estimation, right? So this estimation, because of this is part of the matching principle, according to the matching principle, so you create this bad debt expense, a reduction to your equity account. Now you also created another allowance for doubtful account. It's a contra asset account to your accounts receivable, so it's a negative to your asset. So the accounting entry would be the debit to bad debt expense and credit to allowance for doubtful account. So here's how you do the adjustment for estimated bad debts. So you started out in January 1st, you had a sale. So when you made a sale, before you even collect your cash, you have to recognize your revenue because you already made your sale. So you create this accounts receivable of $120,000 and then you also created a sales revenue. So by the end of the accounting period, this is the end of the month, we estimated saying that $900 of this out of this 120,000, $900,000 we estimate it says we may not be able to collect them. So you create this now you have to this recognize this bad debt expense, right? Because this is expense associated with the sales in January. That's why, according to the matching principle, you have to, based on your estimation, have to recognize the expense. It's called bad debt expense. This is a direct reduction of your equity, and it's an operating expense. And at the same time, you also created this contra asset account called allowance for doubtful account, and that account is a deduction to your accounts receivable. So in your balance sheet, you have accounts receivable that's a $200,000. This is from your prior balance. Now you have another $900,000 of $900 of allowance for doubtful account. That's part of this $15,000. And then in the bad debt expense, that should be bad debt expense in your operating expense. $900, right? You have sales revenue and you have a gross profit, you have a $900 as a part of your operating expense. So now later you know that $800 of this bad debt that you already estimated definitely is not going to collect it. You know that $800 needs to write off from your receivable because you know that the company could not pay you. Either this company go bankrupt or you made some negotiation with them. You allow them to not paying you back for $800. So at that, you already recognize your expense. So there's no need for another expense entries. All you may need to reverse out the entry you created. So in the allowance a doubtful account, initially you created for $900. Now you have to reduce $800. So it's a reduction to your allowance for doubtful account. And then there's another reduction, right? Reduction to your accounts receivable account because initially you only created a allowance for a doubtful account when you estimated. You did not make any reduction directly to your accounts receivable. Now, because you already know, so you have to deduct directly from your accounts receivable account. So that's the transaction. So you have a reduction of $800 to your allowance for doubtful account. Remember, reduction to your allowance for doubtful account is a credit balance. Now you're debiting it. So, and you also have a reduction, direct reduction to your accounts receivable. So when you initially record accounts receivable, you have a debit balance. So now you have a reduction of $800. So if you look at the T account analysis, so look at accounts receivable, beginning balance of $200,000. That includes $120,000 sale. You made it already, right? By the end of January 31st, you have $200,000. Now you say you're going to have a $200 of a reduction to your accounts receivable. So your ending accounts receivable is going to be 199 to $199,200, right? So in your bad debt expense in the beginning, because this is expense account, you should not carry balance from your prior period. So in the month of January, you made an estimation of $900. So at the end of a period, you still have this $900 of estimation of $900. You're not going to change this amount. Remember, this is very important, right? You recognize it later when you know this is not going to be collectible, partially not collectible. You don't need to go to do any adjustment with your bad debt expense. All you need to do is allowance a doubtful account. So in the beginning, you have 14,100. So now you say estimated additional $900. So then it's a 15,000. But now you said, okay, out of $900, I know 800 is for sure not going to be collected. So you reduce it from allowance from doubtful account, but you also reduce it directly from your accounts receivable account. So there are two ways to estimating the bad debt expense. One, what we call percentage of credit sale method. This is very easy and simple to apply. You just take the balance and apply the percent based on your historical experience. So another way is aging of the accounts receivable. Let's go through details of these two methods. So percentage of credit sales, as I just said, you just estimate bad expense by multiplying the historical percentage of bad debt loss by the current period's credit sales. So your historical could be last 2 years, could be last year, could be last 9 months, right? So you get this estimated percent. Here you say it's 0.75%. You time this estimation, the percentage to the total credit sale for the month. That's your additional bad debt expense for this month. So here for the VFC example that we had, we just saying it's a 0.75%. So of the credit sale you made, so what you did is just 120 times this 0.75, and that's what you get. And the transaction is bad debt expense of 900 and allowance for doubtful account of 900. So aging accounts receivable, there are two approaches involved. First, you focused on estimating bad debt expense. This is the income statement approach because when you estimate the bad debt expense, you create this bad debt expense. It's a reduction to your sales revenue, so it's operating expense. That's focused on your income statement approach. The aging of accounts receivable method is focused on the ending balance in allowance for a doubtful account. And that's a balance sheet approach because see once you do the aging, you create this allowance for doubtful account. And this allowance doubtful account is a contract asset account to your accounts receivable. So it's a balance sheet approach. So the aging method gets its name based on age of each accounts receivable account at the end of a period. So the older and the more overdue account receivable becomes, the less likely you're going to be able to collect this from your customer. So here's the example of the aging of accounts receivable. So VFC applies aging accounts receivable to its accounts receivable balance on this February 28th. So after taking into account February sale and each cash collection, the method includes 3 steps. First of all, you prepare a aged list of accounts receivable, and then you estimate the bad debt loss percent for each category. So here, so at the end of the accounting period, you say, okay, it's February 29th. How much of you listed by customer, of course, and then their balance of of due, right? The outstanding accounts receivable from each customer. Then you also put the number of the days, right? This is 30 days overdue. This is 90 days, 60 days or overdue. Then over 90 days you prepare what we call the aging of accounts receivable or accounts receivable time schedule, right? The second step, based on your age, then you apply the estimated percent of uncollectible. So the older it gets, the higher percent you're going to apply for, because if it's over 90 days, the possibility of collecting them substantially increase. So you apply this 40 and 20. These are again based on your historical experiences. So the third step, then you calculate all of them, and this is the balance. Calculate all of these, for 6,000 of the accounts receivable balance times 40%, and then this is your balance. So your balance is the total of the 15,500 is your estimated uncollectible as of February 29th. This is a balance, okay? So, and then in here, at the end of January, you already have calculated the uncollectible balance for 14,200. So at the end of February, you have recalculate this balance, and then now it's become 15,500. So what is really the bad debt expense for the months? Then you take the difference of these two. That's how you get this bad debt expense for the months. So you calculate these balance first, and then you create this the adjustment of the bad debt expense. So in your accounting transaction, that would be, so for the month of February 28th, you have increase of allowance for doubtful account of 1,300. You also have increase of bad debt expense of 1,300, which is deduction to your equity account. That's why it's a minus. And also because allowance for doubtful account, I'm saying this over and over again, it's a contra asset account. So also it's a credit balance. So it's a negative balance. Here's this transaction, accounting transaction, right? You have a debit, a bad debt expense, and credit for allowance for doubtful account. So bad debt expense always different, right? A lot of time, from the amount that later you write written off. If the difference are material, so the companies are required to revise their bad debt expense for the current period. If they can, so you have to go back to revise it if the difference is very significant. It's material, right? And the accounts receivable also you need to put back because you already write it off. Now they say like, okay, I collected the amount you initially says it's uncollectible. Now I collect them back. So what you need to do, you have to put the receivable back to the book, and then by recording the opposite of the written off. In other words, you kind of reversed your initial write-off entries, and then record the transaction of collecting cash. So now you put back $800 of accounts receivable, and then also you put it back in allowance for doubtful account because remember you had a reduction of it, but now no, it's a reduction of your allowance for doubtful account because it's no longer allowance for doubtful account. It's your accounts receivable. It's kind of like a reverse the write-off entry. And then you have to reduce your accounts receivable and collect your cash because that cash is already collected. Now, so there's another things. You may offer your customer as a notes receivable instead of credit. So the difference between notes receivable and the credit to your customer is that notes receivable you have a interest revenues. So company reports notes receivable if it use approximately notes to document its right to collect money from another party. It could be a notes receivable for another company. It could be notes receivable to one of your suppliers or your customers. But that notes receivable is a legal document. It's just saying that there should be a Unlike this accounts receivable, as we said, accounts receivable normally they're interest free, but notes receivable you charge interest from the day they are created to the day they are due. So they have this maturity date. So in the interest rate normally calculation is that the principal times the interest rate times the time. So normally in the notes receivable, the percentage they're given is the annual interest rate, and then you times the number of the period that you're gonna be loan them out. It could be 6 months, it could be 3 months, it could be a year, it could be 2 years, right? So here's the example of how you're calculating the interest. This first one, $100,000, 6% mature in 2 years. So this 6% is annual interest. It matures in 2 years. So in the first year, from January 1st to December 31st, first year, you would have 100,000 times 6% times all the 12 months, because this is 12 months for the year. If you started in January 1st, right, it's a $6,000. So next one, it says like I'll loan you for 10 months. Your notes receivable will be mature in 10 months. So if that's the case, it should be 100,000 times 6%. Remember, this 6% is annual interest. So what you need to, you have to allocate it for 10 months. So it's 10 out of 12, it's a $5,000. Then it could be 2 months. So if it's a 2 months, then it should be 2 out of 12 allocated only for 2 out of 12 months, and it's only $1,000 of interest revenue. So here's the four key events occurred with any notes receivable, right? The first key event is that the date that you created your notes receivable. That's November 1st in this example. You just created your notes receivable. And that notes receivable you created, it's a legal document, and they tells you the interest rate is 6%, and the amount of the note is 100,000, and the maturity date is October 31st, 2016. So in other words, that is a year, but you started on the you know November 1st, and then it's October 31st. So, and then there's another date is very important, right? The one date is the maturity date. No, it's the annual year end of the company. So why is this important? Why is this important? Remember in chapter 4 we talked about adjustment entries, right? So at closing of accounting period, you have to make two type of adjustment. One is accrual adjustment, one is deferral adjustment. For this one, can you guess what kind of adjustment is that? We'll talk about this later. So let's see. On November 1st, the VFC lent $100,000 to a company by creating a note that require the company to pay VFC 6% interest and 100,000 principal on October 31st, 2016. These dates are very important. So in November 1st, what accounting entry should I record? Because on November 1st, you lend this $100,000 to a company. So you give out this cash, $100,000, right? So you should have a reduction in your cash of $100,000. So what are you getting? What you're getting back from this company is your note, right? It's a promise that they are going to pay you back and give you the right to collect this $100,000 money back. So it's you should have a notes receivable from your customer. So at the same time, you should have another increase in your notes receivable. Notes receivable is a part of your asset. So it's notes receivable in your asset increase. So in accounting transaction, you should have reduction of $100,000 of cash you just loaned to this company. You should also have a notes receivable increase. That's your legal right to collect it back. So that's your accounting transaction: debit, notes receivable, and credit cash. So at end of the year 2015, December 31st, I was asking, so what kind of adjustment that we need to make? So the adjustment that we need to make is always in compliance of the gap matching principle, or the revenue recognition principle, right? So at the end of the December 31st, 2015, you already earned your interest revenue. You earned the interest revenue. You have not yet you have yet to receive the cash of the interest revenue, but you already earned it. So at the month's close, you should accrue your interest revenue from the company, right? So at December 31st, you should calculate your revenue interest, which is 100,000 times 6% and times 2 out of the 12 months because it's only 2 months. So you will have $1,000 of interest revenue that you can accrue. These are already earned from your customer. So in your accounting transaction, you should have interest revenue, which is in increase to your owner's equity account, shareholders equity account, and you should also have what? Interest receivable. That's your balance sheet, the asset account, interest receivable from the company. So here it should be interest receivable increase of $1,000, and you also have interest revenue increase of $1,000. That's your shareholders' equity. So the transaction entry would be debit interest receivable and then credit interest revenue. So by the October 31st, 2016, your note receivable matured. Once you mature, you should able to receive in cash for all of your interest revenue. So now you should record it. So by the December, this is a full year, right? It's a full year, $6,000. But this is the amount of cash of the interest revenue that you should receive at the end of at the maturity date, which is October 31st, 2016. But how much revenue now you should recognize? Should it be $6,000? No, because you remember at the end of the 2015, you already accrued $1,000 of revenue. So by October 31st, 2016, you should only now recognize your revenue of $6,000 minus $1,000 you already accrued. So it should be only $5,000 of interest revenue, so additional interest revenue that you need to record. But how much of the cash you should receive? It's a $6,000, right? So in here also remember at the end of December 2015, you also created an account called interest receivable. The interest receivable is $1,000. Now you should reduce that because you already received it. You no longer should have this receivable. So here's what you needed. So here in December 21st, you have this, right? This is $1,000, only 2 months of this. And then from this whole period is 1 year worth of the interest revenue, and that's the interest received. So here's your transaction. So your cash, you should receive the full year worth of interest revenue. And the interest revenue here is only 5,000 in addition, right? Because you already recognize $1,000. And then interest receivable you established at earlier when you at the end of 2015. Now you need to reduce it because you no longer should have interest receivable. Okay, this is the accounting entry. So you debit $6,000 cash in total, and you should reduce, which is credit of interest receivable $1,000, and you need to recognize additional $5,000 interest revenue. So there's another transaction, right? Very important because by October 31st, not only you're going to receive the interest revenue, you should also receive the whole full principal amount that you loaned. So in here, you should have cash increase of $100,000 and then decrease of note receivable. That's just a reverse when you initially loan the amount, right? So debit cash 100,000 and credit notes receivable of 100,000. So as when we're talking about the inventory side of it, you want to know like how quickly your inventory turn around because that's the efficiency, right? So now you have accounts receivable. You also want to know how quickly you can collect the cash back from your customer. So that's what we call receivable turnover ratio. So how many times on average, the process of the selling and collecting is repeated. This is the number of the time. But then the higher the ratio, the faster the collection of the receivable. So you sell, you collect, you sell, you collect. How many times did we do that? That tells you the efficiency of your operation, right? Then rather than the number of the time, this is kind of like hard to explain it. You also want to say it would be easier to think like say how many days takes for the company to collect the receivable. That's called the days to collect. So the calculation is similar. So you say the net sales receivable revenue divided by average net receivable average should be the beginning balance plus the ending balance. You divide it by two, that's your average. And that's saying, so in your, the with that amount of the revenue you are saying, it takes you 10 times to sell and to collect the cash. So now here, so how many days it take me? You just take the 365 divided by 10. It's 36.5 days takes me to collect the cash for each sales that I'm making. So the company sales on account, they specify the length of credit period, right? So normally, remember in the last chapter when we talk about the inventory sale, you have this N backslash 30 days, which means they tells them like, okay, I'll there's no discount or interest if you pay me back within 30 days. So the credit period is 30 days. So the notation would be N backslash 30 days. And it could also be 2 backslash 10 days. What does this mean? It means if you pay me back within 10 days, I'll give you 2%, additional 2% of discount. By comparing the number of days to collect to the length of credit period, you can again to gain some sense, okay, whether your customer are complying with the stated policy, right? So here's this ratio comparison between different companies. See, collect has the lowest number of the day to collect. That means they have a efficient, more efficient in collection of their receivables. So with the accounts receivable stays outstanding, it gives you like, lesser your liquidity, right? Kind of drained up by that because a lot of time you wanted this cash on your hands so that you can have this quick turnaround. You can use the cash to buy the material, to buy the inventory, and then to sell, and then to create this quick turnaround. So, what about like, what are the ways that I can use to speed up collections? Sometimes there's a company called like factoring receivable. These companies just come in that they buy the bulk of receivable you have. So they can go now to collecting those receivables. So by selling these, remember the accounts receivable is your rights to collect from your customer. So when they buy these rights from you, of course you have to pay them a fee, additional fee, right? So the fee it's called like that you receive the cash for the receivable that you sell to your factors, but minus a factoring fee. That way helps you with your liquidity. So another way to avoid a lengthy collection period is allow your customer to pay for it using PayPal or credit card, right? So by using PayPal or credit card, you give all of these uncollectible risk to these credit card companies, to the PayPal and the credit card companies. So of course the PayPal or credit card companies will charge a fee for their services. But instead, you're getting a much quicker cash from these credit card company, or also reduce your risk of uncollectible. You kind of like transfer the risk to those credit card companies. So this is said for chapter 8. Please go through some of the examples in the slides before you do homework. Have a happy Thanksgiving. I'll see you the week after Thanksgiving. So the Thanksgiving week, we should not have a in class section. The week after Thanksgiving, we have we'll resume in the class for the in class section.